Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 291 for February 22nd, 2021. We had some little technical difficulty earlier, so we're recording this now at a little after 2 p.m. Eastern Time. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today I have the option professor here to do his monthly solo episode where he's going to talk about the markets. And I'll go ahead and turn it over to him.
Okay, thanks, David, and welcome everybody. Sorry for being a little bit late here today, but better late than never. And hopefully we give you some good information that you can chew on here. Quick background on the optionprofessor.com. We've been doing this for decades, educating people on the uses and risks of options, and also giving our opinions and our observations on what's going on in the markets, which I'm going to do here today. Again, we'll cover a wide variety of the markets, which we do every week in our weekly newsletter, which comes out to you free of charge, and we'll go over that at the end of the broadcast. But again, I'm a graduate of Boston College, and I've been doing this for decades as far as education. So obviously, we believe we have the background and experience and knowledge to help you answer some of the questions you have and have some basis of our opinion and some basis on our observations. All right, let's jump into it here. The stock market went down in the morning, then it came right back up again, which is what's going on right now. On your screen, you can see a chart on the S&P 500, which goes back 20 years. What this tells us is that the trend on the stocks have been up for a very long time, since the crash of 08, right? This thing got on its bicycle in 2010, and it pretty much hasn't violated that blue line only a couple of times here. And then, of course, it did by a lot. But what happened when it got violated back in March is the Fed came in with 14 facilities buying everything in sight, creating liquidity so that we got back above the blue line. And once it got above 2,800 on the S&P, it was game back on. So the bottom line is the direction of the moving average has been higher, and the market has been above it primarily the entire time for the last 10, 11 years. So that's where you are. Now, what can you also say by looking at this chart? That it's very, very, very extended on a historical basis. It generally doesn't get this far away from the red, green, and blue lines. Those are three obviously different moving averages: 12, 24, and 36, 1 year, 2 year, and 3 year. Okay, your RSI is in good shape. It's above 50. That's where you want it if it's in a bull market, right? Last time it was well under 50 was back in 08 during the crash. But again, even during the big crash here, you barely got underneath 50 and you're on the bicycle again. So this has been a very long bull market. What's the only thing you can say about it right now? It's very extended. And what does very extended sometimes mean? It means you're going to pull back to the mean. What would make it pull back to the mean? Obviously, interest rates have changed dramatically. That's going to be affecting things. You can see Apple and some of the larger PE stocks are giving it up a little bit. And one of the reasons is the change in the interest rate environment. I'll show you the change in the interest rate environment very quickly so you can put it in perspective. Each week, we show you what's going on in stocks and bonds and crude and everything else. Well, we do go over this as well. And we've been telling people that the 180 price we saw in March was a generational top, we believe. You see that high? That's when interest rates on a 20-year treasury probably was at 1 or less than 1%. And you know what? We think it's the direct opposite of what happened with Volcker when it was at 16%. So we think it's very possible that that's the end of a cycle. It's possible, although you have to admit that the trend is still up and we could come down here and then rates could drop again. Okay. But if you look at it on a 5-year basis, it clearly tells you that the trend has rolled over. Okay. But on a long-term basis, the 20-year graph, it is still a reducing interest rate environment. What could most likely be occurring is if it holds this 1.5% to 2% on the 10-year, that maybe we trade in a range of 125 and 150 for a while these averages catch up to it. But it looks like extremely low interest rates could be in our past. Okay. And of course, the level of the debt, the fact that they want inflation to come back, these are all not good for the bond market. But you see that move down there, that sometimes can precede the move in stock. And again, as we showed you on the S&P, it is not difficult to imagine that something could occur that would cause the tremendous enthusiasm and the tremendous, shall we say, bullishness to see that, people could take some profits and it could pull back. So defensive tactics up here. When you get a better sign, let's see what the S&P again looks like here. And see if we can get a graph up there on the S&P. Okay. And again, where do these averages come in? 3,000. What's the other one at? Let's see. 3,000, 3,150, and 3,329. Again, the most logical place if you had a big pullback would be the high of 3,400. Some people think 3,550. And we're not saying it would come in a direct line. It could go down in March a little bit, bounce up in April a little bit, then back down in May and June, creating the ultimate low in the May-June timeframe. Okay. Now, let's look at it on a shorter term basis. 1 month chart on the S&P. There you go. It looks like it's rolled over a little bit, as long as it stays underneath about 39. Well, I would say this point here is probably pretty important right now, 39.30, something like that, where it bounced last week. If you look at a 6 month basis, it's still hanging in there. Okay. And so the support comes in at 38.25. So we've been saying this line here, which is 38.50, 38.50, very important to hold, and then 3,800 down here. So our belief is that if 38.50 and 3,800 does break and your VIX is above 25, then it might be setting the stage for the initial pullback that we think could happen. Again, still looking good. No signs that it's rolling over really, except on the monthly. The 6 month is still hanging in there, and it's been hanging in there pretty darn well. So obviously it's been, it got broke here a little bit, not for very long. The direction was still up. But see, your red line here has been getting to break, and that's at 39.05. So staying under 39.05 would add credence. Getting under 38.50 would add more credence, and then breaking 3,800 would give even more credence. And what's the RSI doing? The RSI right now is coming in at around 59. So if you were to break under 50 because the market starts to break, then we would very much respect the concept that a pullback might be happening. Again, the change in the interest rate environment is one factor. The factor that they might fight over the stimulus package is another. The fact that they're doing transfer payments, which have a temporary effect, not a permanent effect like an infrastructure bill. And, just the earnings of being so high, the earnings are great, but some people are thinking that Q1 earnings and Q2 earnings may not be the same as Q4, where we had a pretty good pop in earnings. For the year, again, people are still looking for earnings to be up 27%, which is great. And people are still looking for 4,300, 4,500 on the S&P, which is great. But that doesn't mean the market can't pull back first. And in that pullback, very few people are prepared for right now. So again, we're monitoring it very closely, and we don't want to be caught with, with our mouth open catching flies if we start seeing a deterioration. Some people who work with the cycles and Elliott wave stuff, they were looking at the 31,700 area on the Dow to be possibly a high point. So far on the S&P, the high point is 3960. So either A, it could roll over from here, or B, maybe it makes a run at that 4,000 number. And then at that point, maybe something comes in. The month of March and April in the last few years have seen some declines. So it's not off the chart as far as that's concerned. And again, it has been pretty unabated here for about 500, 600 points. Okay. And your RSI has not been making big new highs here. You see, the RSI is actually not as high as it was over here. So when you have a high point here and another big high point here with the RSI not making a new high, sometimes that's telling us something as well. So we don't want to play the guy who cried wolf, but we don't want to be Walter Mitty walking around thinking that the market can never pull back. So there you go. That's a little bit of an idea on the stocks. Now, some of the stock areas that seem to still be reasonable are in the value sector. And I'm going to be using some examples here of value. This is a Vanguard Value MGV. something we got very positive on as it got, above 79 and 80, because we think this pays, 2.5% dividend or so. And we thought there'd be appreciation as people went into things that were not way overvalued as far as the PE ratios. And as you can see, that has worked out very nicely. And also it's not that overbought. And there's the 52-week high. 52-week high is not very higher than it is right now. So it's not anywhere near where I'll show you something else. Let's put up the QQQs to give you an example. And on the Qs, you can see, I'll go back, let's go back on a 5-year graph so you get a better idea. You see how the Qs went, 15% above its all-time high? Okay, and it's pretty extended from the numbers. You'll notice on the value, that you're not seeing the same type of extension. You see, there's the 52-week high, and it's only like a buck or two above it. So it's hardly anywhere near as extended as the other. It still could have pullbacks, don't kid yourself, right? But again, as far as being where the 52-week high is and where it's trading at, we're just getting through the 52-week high. So on a pullback, you would imagine this may be less volatile. Same thing on, there's stocks like NVIDIA coming out here with earnings, I believe, this week. Let's take a look at that to give you an idea. And again, these are valuation plays as well. Now, this is a great company with great stuff going on, but again, it's $100 above its longer term average on a 5-year basis. You want to see, and again, this is where what was the 52-week high on this thing going back to last year? Yeah, so it's double. It's 100% above the high of last year. That seems like a lot. Also, the RSI, we're making big new highs here, but look at the RSI, totally lagging. So, and you got a high point there surrounded by lower highs. So is this a vulnerable stock? Possibly. Yeah, it could be, or it could go to 650 and then become, but the higher it gets from the moving average doesn't make it less risky. And the higher it goes without the RSI confirming it, that doesn't make it less risky. Okay. And we're trying to avoid the boom and bust stuff, because when they do have corrections, these ones on a percentage basis could get hit a little bit more. Okay. So we looked at a little bit on the interest rate market, and we looked a little bit on the stock market. Other sectors that we have liked, obviously, were the banks. Again, in that value play, were the banks and were the energy and were the industrials. Those are the sectors that are considered value. And let's take a look here. You can see this thing is the financials. That include your JP Morgans and your Citigroup and your Bank of Americas and all that stuff, Wells Fargo. And as you can see, there is a buy signal here, comes in around 60, and obviously it's already at 80, but it's still not that far above its 52-week high. So there could be more real estate to come. Doesn't mean it can't pull back, but that inverted yield curve where short-term interest rates are low and then long-term rates are going higher, that's ideal for the bank. And it's something that in our newsletter, we told you about months ago, that the yield curve, because people were going to get nervous owning bonds 20, 30 years out and getting no interest, and that's what's happening now, because that's why they're coming out of the bond market, because they're selling bonds because they can see the yields are ridiculous. Based on what? Based on the growth? Based on what? The inflation numbers that are expected. And the third thing is stimulus. So you put stimulus, a very big GDP number, and you put an inflation number that's going to be way higher than people think maybe, then you can't hold on to bonds that are paying 1% or negative interest over in Europe. So there's a real risk in the bond market, and it has already come to fruition because you saw how TLT has gone from 180 down to 140. That people are exiting this, and they're replacing their need for income with dividend paying stocks like the values. Okay. And so basically that's what's been going on, something that we've told investors about for months and months and months. No surprise if you've been getting our newsletter. And another one is the energy market. Energy went down to minus $37 a barrel. Okay. Now that's called capitulation. at that point, look where we were on the energy ETF, and this includes your Phillips Petroleum and your ConocoPhillips and your Exxon and Chevron, and includes your Halliburton and Valero's and all those guys, right? Well, this thing gave you the buy signal at about 47, and now it's at 66. But look how far away it is from the 52-week highs. Okay, a long way away. And again, on a 20-year basis, it gives you even a better perspective that, this thing bottomed out in the 40s, it's in the 60s. Now it's still in a downtrend long term, so it doesn't, but going towards 70 or 80 on this thing is not out of the question, and the crude prices are expected to be good. Private equity, which used to be so heavy into energy, they're going to probably be hesitant to invest, which means the supply should be rather contained unless Saudi Arabia and Russia next week decide to let the spigot out. And then, of course, you've got things thawing out in Texas, and that could give you a short-term situation on crude that could give you a correction. But the bottom line is demand should be very good looking forward, and the supplies should rather be reasonably contained, and that's sometimes a good recipe for higher prices. So while we obviously got bullish in this area a while back, we think any significant pullbacks would be very good places to get on. And these companies also tend to pay pretty healthy dividends. So you're getting paid income while you're watching the movie. Sometimes not a bad thing to do. And then, of course, you've got dividend payers, high dividend payers, paying 3% or better, compared to where you get income elsewhere, not bad. And this is an example of one, the high dividend yield at Vanguard. And you can see the all-time, not the all-time, I know it might be the all-time high, but last year's high was coming in here. And now we are a little bit above it. So, the highs used to be around 95, 94, and we're at a little bit higher than that. But the moving averages look like they're getting ready to go. And hopefully that would be an indication that it could keep going. And look at the RSI, very nice, turning up at 62. So we think there's a bright future there. And again, it pays income through dividends and distributions. So again, as part of a balanced portfolio, it's not the worst thing to think about. And again, at least you're not buying something that's already gone through the roof. There's a couple of stocks here that we think are kind of interesting. Apple went up to 145, pulled back here to 125. And obviously looking for a place to maybe get into Apple. And you can see the long-term average on the 1 year comes in at around 109. It'd be fantastic to be able to get it at that price. But, coming in here, the 5-year on the 5-year graph, 117, that could be a decent area to take a look. Obviously, it's been holding the 123 level. So that's good as well. And the RSI is coming down towards 50. So, if the RSI can hang 50, and right now it's at what, 55? Yeah. If it can hang at 50 and stay above, that's bullish. And if we can hold above 117, that would be nice. And then, like I say, if you could get it between 110 and 100, that would be fantastic. But it looks like, 110 to 120 might be your best case as far as if it really got whacked because the market had a correction. Another one that has dropped is BABA. And on a long-term basis, it is breaking down a little bit here, but looking at it on a 20-year, it is still above the numbers of the moving averages, which are at 200, 215, and 246. So it's been holding this green line, which is 215. So somewhere between 215 and 250, if it goes back in that zone, it might not be a bad thing to take a look at. And then again, the RSI is still hanging at 58. So as long as your RSI is above 50 and you're above some of these lines, this could be a discounted price that may not last either. These guys have a lot of businesses that they can make money with, so that's interesting as well. And the general Chinese stock market has been doing pretty good. So again, BABA's starting to look a little more interesting rather than at 320, somewhere here in between 200 and 250. Okay, and then there was another one on the pharmaceutical side that some people are thinking is a pretty good value down here as well, and that's Teva. And Teva's been having trouble lately. But again, the formation is interesting to us if it can get some legs. Clearly, if it can get above 15, it opens the door to all these other numbers. So keep an eye on it and see how it does. If it can't get above 15, obviously it can't get into these areas up here. And if it can, I think it's a pretty good deal. So keep an eye on that because pharmaceuticals, again, and generics are going to be a big part of the future and always have been. Let's look at a couple of other things that are crossing over with regards to the ways to get. I'm going to go over different things. Like the next thing I'm going over right now is income. Okay. And people like to get some cash on their money. And so some of the ways that we look to get income would be a short-term corporate bond investment grade fund. Now, again, you're not going to get rich on this stuff, but people park money in it, and with the short end of the curve, the Fed has some control over the short end of the curve. So as you saw the 10-year note TLT tanking on its moving average, you can see this moving average is still rising, and so it's still in a reasonable good condition as far as being uptrending. And that has duration here of about 2.5 years or so, which is not too shabby. It's a relatively short term, and it is looking at investment grade. Again, you get prospectuses and all the details at the Vanguard site if you have an interest in looking into it further. I'm just showing this for illustrative purposes. Now, like I say, when people want to get a little higher yield, sometimes they go to these other things to make some money. And this is preferred stock. And a lot of these preferreds are in banks, which seem to be doing pretty good. So basically on the preferred here, again, they had tough luck when it went down here during the crash, but they're back on the bicycle here. So as long as it stays above 36 and change, these things are interesting to people as well. That's a ETF of preferreds. Another one is high yield. And high yield is where you're getting, less than investment grade. And give you a little example of that. If you notice, when you look at the Vanguard funds, they have management fees, but the management fees are far less than they are at other companies, which makes them very interesting. In other words, rather than a 0.5 point or 1.5 points or 2-point management fee, these guys are well under a 0.5 point. And so that's why it's interesting. And again, this is your high yield. And as you can see, after that big drop, it's been hanging in there pretty good. So some people are thinking there's value there as well in order to get some income. Next one would be in emerging market sovereign debt. And this one here also people look to get some income on. And as you can see, unlike the TLT, this thing is hanging in there a little bit better. You'd like it to stay above 78. And that's emerging market government bonds. And they're the yields on the ones I'm mentioning, the last three of them, are higher than they get in a short-term corporate. So people sometimes pepper their portfolio with some of these other things to try to increase their overall yield. So those are a few different ways right off the bat: the emerging market, the preferreds. And another one that I keep an eye on, we keep an eye on, is floating rate. If interest rates are to rise, these are relatively short-term in duration, so they're renewing a lot. So if rates go higher, they renew at a higher and higher rate. And they've gotten back on the bicycle after that big drop as well. And these things are floating rate, high income. And you could, again, through Fidelity, you can look at their prospectus and see what you think. But that's another way people try to get better cash flow and income. But again, there's going to be some share volatility, so you have to be willing to absorb that. But those are some of the ideas that are out there in order to try to increase your income, in addition to the dividend paying stocks. And again, that's why some of these energy shares are doing so great, because they pay good dividends and the price is going up. That's why the banks are doing pretty good, because they pay good dividends and the prices are going up. So again, that's why people are going into some of these things. Also, REITs are somewhat interesting to people. Vanguard has a REIT. Those are real estate investment trust. And basically, these have various real estate in them, not just REITs, but gives you an idea that these are just emerging now, and they pay pretty good dividends. And again, it's a tangible, it's investments against a tangible asset. So that's interesting to people. So you might want to keep this on your radar, because it's looking like it's coming out of the box. And it is also gaining steam above 50 on the RSI. One REIT that we keep an eye on here is Whitestone. And with Whitestone, they pay monthly. And so you could look into that. And they've been doing pretty good lately, but they're way away from their averages. And looking at it on a 5-year basis, they're starting to make a turn here again. And they may offer some value if you do your own analysis. This is a 6-month situation. You can see it's breaking out on a 6-month basis very nicely. And you certainly wouldn't want it underneath 8 or 780. So as long as it's above there, they pay out monthly, something to take a look at for people that are looking for income. Let's take a look at the US dollar, because everybody hates it. Let's see if that dislike makes any sense. Nope, hold on a second here. Let me get that up again. US dollar index, there you go. Now we got negative on the US dollar once it broke under 100 and 104 earlier this year. So you'll see why in a minute. You see it was trading up 104. Once it got under 100 and once the RSI started breaking under 50, it was time to get negative on the dollar. But now it's kind of holding on to this 88 area, and it's been holding on to it pretty well. So basically, as long as we stay above the 88, 87, there's a possibility that we go back up here, because the yield advantage has returned to us. That's possible. If you blow out the 88 area, though, it looks like there's not much to catch it underneath. So that's why the dollar's in a dangerous spot. And we'll get into the gold and silver and Bitcoin in just a second. But that's why they're thinking the dollar is in a little bit of a weaker spot. Now, that's a long-term graph. Looking at a shorter-term graph like 6 months, again, it is still underneath the averages, and it's back underneath there. So again, it's holding this 89. Could we go down and test that? Yes. But if we got above 91 and 91.50, then that would open the door to a contra trend rally. And that's something that we're kind of keeping an eye on. In a 1-month basis, it has broken back down though. Okay. And the RSI is back down. So the dollar index right now is treading for its life. And if it can get above 90, 60 and then 91, then that would change the tune. But right now, that's not the way it looks. Right now, it's on the defensive, which means your British pound is looking good. It means your euro's looking good. It means your yen's looking good. It means your Aussie dollar's looking good, and your Canadian dollar's looking good. Okay. Looking at, and where's the RSI here? See, one thing is you're going down and making a low on the 1 month, and the RSI is not making much of a new low. So that's a little bit of a divergence, but not a big one. The key to the US dollar is you need to have it gain some strength. And if it does gain strength, then you don't want to fight it. Right now, the path of least resistance continues to be down. But because of the lower nature and the popularity of being negative the dollar, you have to be a little concerned from that standpoint. But clearly, as I showed you, the trend is moving to the downside. Okay, so if that's the case, what about things such as Bitcoin? When we look at Bitcoin, we look at GBTC, which is Bitcoin Trust, Grayscale. And this is something we've been bullish on since 10 and 15. And then, of course, it's run nutty to the upside here. Let's give you a 5-year graph and see if it can give us a little better numbers here. Let's see. There you go. So you can see this is why we would get bullish, because the thing is starting to break to the upside, right? Now, of course, we thought it was going higher, but we didn't know it was going to be going up that far. Now, that's extremely extended. Now, again, we all know that Bitcoin has a very illiquid situation because there's only so many Bitcoin out there, and a lot of it's held by a relatively few amount of people. So when these guys are not selling, and all the money from the corporations and all the money, from Tesla, and all the money from all these people come in, it squeezes the market, and that's why you get the volatility. But from time to time, you get 30 to 50% pullbacks. We just got one. We ran up to 50 on this thing, all the way from 10. That's 5 times on your money. And then it pulled back all the way to 30. So that was a nice 30% drop or so. Now we're way up here at 60. Let's look at the RSI and see if it's confirmed this rally. It might be telling you the next drop is coming. Yeah, can you see here that the RSI is not making any kind of a new high? And the market made this huge high up to 58, was it? Yeah, 58,000, which is 58 on this thing. Okay, so look how far you are from the averages. If you were to drop, and some people think it could drop back towards 20, but I don't know if it'll go that far. But from 58, a 30% drop would take you down to 40. That's certainly where the gap is. That makes some sense, right? And the moving average right there is at what? 38. So 40 area makes some sense. And then if you were going to drop 50% from the 58 number, then that would give you a pullback of back towards 30. And again, that the number here comes in at 25 and a half. So will we get this kind of a drop? I don't know. It's possible at any point, because when these people who are controlling it decide to dump, they could have a situation where it could create more volatility. A lot of people, and we told people this last year, that the year after halving, which is this year, is generally a very big up move. So that's why we were positive on this thing way at the lower levels. But we're really not too comfortable getting too extended at 60, because it's a bull market, and on a bull market, you're supposed to buy the pullbacks, not buy the strength. But at any rate, it's been a great thing to own. But up at this level, obviously you got to use risk capital, maybe dollar cost averaging, some type of technique to ease the pain in case there were a drop. And the potential on this, some people are saying, is 100, which would be 100,000 on Bitcoin sometime this year. But we'll have to see. That diversion on the new high here, is sometimes a little problematic, because as you can see, back in July of 18, when we went up to 40 and the RSI did not make a big new high, it did have a pretty good rollover there. So hard to say exactly what's going to happen, but if you're a guessing person, the potential for a pullback is certainly there. So that's the story on Bitcoin. Let's take a look over at the gold and silver, and I'm going to look at the mining shares. GDX and GDXJ. And this stuff we actually took a bite on here today when it was opening up, because we thought that it might bounce back. But right now, you have to say that it's still on the defensive. But it'll be interesting to see if this low point here, which is at 32 and a half, holds up. And that's not a bad line in the sand, because you can see these areas here at 32. These are former highs around here, and those are former lows. So there's some kind of a reason why it could bounce a little bit out of here. The key is getting gold back above its 1-year moving average, which is 1820, 1830. So we get it, or actually all the way up to 1850. If you can get the gold itself above 1820 to 1850, then I think that this would make more sense. Right now, if you look at the long-term 20-year graph, you can see that it's still in the bull market, and this thing really has a lot of support right there, again, at around $31 a share. And getting back above its 1-year moving average, which is 35.60, would be very positive. So again, somewhere around here, 30 or so, no less than 27 and a half, should be a situation where it might not be a bad thing to look at buy-wise, because look, you're at right around 50 on the RSI. So everyone's throwing the gold out the window a little bit, and maybe it's time to not do that. And if the money comes out of Bitcoin, it maybe will rotate into the gold. Now, there's another one called the juniors. And, these are basically a faster moving form of the big ones because, the idea here is if the big ones want to increase their reserves, they could buy the small ones to get more reserves, which is what the idea is between these. These again pulled back, and if you can get above that red line, that would be nice. You can see in years past, it was as high as about 100. So there's still plenty of upside if it gets moving. The RSI again, right around that 50 number at 56. So if we can get above 55 here, this thing I think would get back on the bicycle. And we are kind of positive on this longer term. So again, you still got risk down to these numbers down here. But if it starts breaking up, it might be time to reconsider. Silver actually is holding up a little bit better. SIL. And SIL is, again, see how it held the 1 year? Perfect, right? And now it's back up. So as long as it stays above this 40 number, we like it. And the RSI is probably doing pretty good. There's your RSI, not way up, but it's above 50. And basically, if you look at the juniors, SILJ, chart looks a little better on silver than gold. And there you go. You tried to come down and test the 1 year here when it dropped down to 1350. And now it's trading at 1344, so 1350 area. We're bouncing up here again. RSI is looking pretty good, but overall it looks like it's doing pretty good. So being bullish the mining shares on silver doesn't seem like the terrible idea. One market that we brought to our readers' attention a long time ago was Freeport-McMoRan, and you can see it was definitely home run derby here. So we thought it looked like a good buy as it broke above 10 and then 15, and you can see why. And again, the RSI was getting above 50, and this thing is really taken off. Now, obviously, it's very extended here, so it's hard to do much with. But it does still look like it has plenty of real estate to go, and copper is in a bit of a squeeze. So if they can pass infrastructure, this thing has potential. But of course, we would prefer to buy dips if and when they come. Another one we showed people in that copper space was Southern Peru. This thing paid a dividend. So you're getting paid a dividend while you're watching this movie, and that's a good movie to watch while you're getting paid to watch it. Oh, this is a wrong symbol. So let's get that corrected for you. Southern Peru. Now, these guys had trouble in Chile with their supplies because of COVID and other factors as well. But again, this thing we got bullish on 35 to 40. And as you can see, it's been a heck of a thing to own. And again, this thing pays a dividend. So you got a dividend plus you're getting growth, and that ain't too shabby. Again, very extended here, though. Very difficult to start initiating positions. You want to try to get them as they're coming out of the chute, not after they've run up so far. So that's something as well. A dark horse that we think has some potential is in the platinum market, similar to copper in that it's an industrial usage thing. And we are looking for a big potential when the catalytic converters are needed and the auto companies come back online. We think there's going to be significant demand potential here. And so I'm going to try to get you a cleaner graph here that we could look at. Look at a 6-month graph and see if it gives us a better sign. There you go. So again, anything at around 950 to 1,000 is when we were letting people know that we were constructive on this in our opinion and our observation. And again, palladium catalytic converters are much more expensive than using the platinum. So we're expecting this to have a good time of it. Looking at the longer term graphs, you can see that it is building. And you can see there is quite a bit of real estate above if it wants to go. Again, it's breaking out on a 5-year basis to new highs, but look at it on a 20-year basis and you get an idea that it's got some room. You know what I mean? So you got 1900 here and you got 2300 here and you got something that looks like it might want to go someplace. So obviously this area of 1300 where the lows are is a problem. But if it gets above there, hitting 1500 looks like it'd be possible, and maybe even test the 1900 area if it got going. So pullbacks here or breaks above 1300 would be very interesting to us. And that's a dark horse from the standpoint of not everybody's in it, not everybody's talking about it, and that kind of thing. Just like copper, nobody really talked about it like they did the gold and silver, but it had the biggest move of all of them, right? Okay, so that gives you a little bit of an update on the metals and the dollar, anti-dollar movement. We talked about the crude. We didn't give you anything on the gas. So we give you a little bit on that. LNG is our play on the natural gas, and it's been a good play. Again, it's up at the 68 area. It's had a big run, but the bottom line is, once it got above here at the 50 mark, that's when we got positive on it. And now it's up at 68, some resistance there. So obviously it could pull back, but the averages are starting to turn. And on a longer term basis, it might still be a good deal. On a 5-year basis, you can see that the support should come in around 56 on pullbacks. And again, there's a resistance up there. But LNG has been a good deal. And, there's another one that Jerry Jones was in called Comstock. Let's take a look at that one because I heard things in the news, and this is something we used to watch quite a bit. Let's look at Comstock here. And, Jerry Jones is the owner of the Dallas Cowboys. They said this thing was going nuts. Let's see if it's gone nuts or not. Yeah, it's only at 596. Well, it's starting to break out. So this is also as a gas play in some regards. And again, it, used to be way up here, went way down here, has a lot of support at $4, broke above 5. And it'll be interesting to see if it can keep matriculating its way up. But that was in the news here. Well, it had a pretty good run, from 5 to 450 to 650 is a 50% jump in a very short time. So keep an eye on that if you're interested in natural gas, because that could be an interesting one as well. All right, let's take a look here at some other stuff that we keep an eye on each week. We went over to different, the stock market, and we went over the bond market and interest rates. We went over the US dollar, international markets. Give you a quick taste on international markets, okay? Because we've been positive on that. The valuations overseas are much better as far as money is concerned, and they're doing stimulating over there as well. So if you like China, we keep an eye on KWeb. And as you can see, KWeb has not been a terrible place to be. Down a little bit today, but that's a heck of a run, right? 50 all the way up to 105. But again, you don't buy at 105. You try to see if you get dips, and you probably get a sharp dip at some point. RSI, again, has not confirmed this huge move, so that 105 is probably suspect to being a sell-off from. But that doesn't mean after a pullback it wouldn't be bad. And so there's some moving averages to play against. Another one for large cap is FXI. And on FXI, another one that's off today, but as you can see, getting bullish at 40, 42, nice run up to 54. But again, it's extended. And the big new high was not confirmed by the RSI. So, it could be pulling back, but there you got some numbers to play with. 46, stuff like that. When you turn over to Asia, one of the ETFs we keep an eye on for Asia and Australia and places like that is the Pacific one over at Vanguard. And you can see that also was a great place to get involved in 64. Now it's up at 84. Again, extended, possible pullback. When it pulls back, there's your numbers to play with. Europe, a lot of people like Europe. And Europe is up today. And again, got bullish 50, 54. It's up at 62. British pound is doing great. The euro is picking up some steam. Germany's numbers are getting a little bit better. So that's something else. And then, so there's your Europe looking pretty good. And then you have got your emerging markets. And here's an example of that over at Vanguard. Down today, but it's had a big run. It looked good here at the 40, 44 area. Now it's extended. You look for pullbacks. So you're looking at 52 and 48 area for possible pullbacks too. And at that point, it might be worth re-engaging. And then you've got two other ones here. One is Mexico. Now, Mexico and Latin America, we're starting to roll over a bit. Let's see if they're hanging in there. I think they're kind of going sideways. Yeah. See, these guys are going sideways. They're still in an uptrend here, so that's not bad. But certainly 37 to 40 would be where you'd want to keep the line in the sand. And let's take a look at the RSIs hanging in there. So, if you wanted to buy the pullback, there's your numbers that I would be looking at right here. We would be looking at right there, 37 to 40 area. And again, if you look at it on a 20-year basis, there could be quite a bit of real estate above if it gets turning. Yeah, you can go all the way up towards 70 to get back to where it's been. Getting above 45 right now would be nice. But it has been downtrending, and that's the problem on a long-term basis. Your long-term trend is still down. How about last one would be in international, will be over there in Brazil. And in Brazil, again, on a long-term basis, having some trouble, gets above 40 would be very good. On your RSI, it's right around 50. So getting above 40 would be very nice. And that would maybe turn the momentum around on a 5-year basis. Similar to Mexico, I think it's having a pullback, but hanging in there. Let's see. Yep, pullback, but hanging in there, but it's getting near crunch time. You don't want this thing breaking 32. And your RSI right now is better hold on to that 50 because you're right at 50 now. So crunch time for Brazil. You want it to stay above 32 and you'd like to stay above 50. And if you get above 38 and 40, then I think you might be back in the driver's seat, particularly getting above 38, because then you have a 1, 2, 3 formation, and then another 1, 2, and then if you blow out 38, then you could be on a bigger bicycle. All right, I'm going to go over a couple of soft commodities here that we have updated people on. And one is called soybeans. And this is something we got positive on earlier in the year, and our readers were very well aware that $8 or $9 or $10 soybeans were looking pretty good because China had to come in and buy, and that's a good thing to hear if you wanted to get bullish. So as you can see, it had a big run. We'll give you the 5-year graph so you can take a look at what happened here. And as you can see, what we said, 859 was your buy signal, and look at that run. That's a big run. That's inflation too. So the bottom line is you're very extended here, but again, it's having a hard time coming down. But if it does come down, $13 where it stopped would be one area. And if it's going to have a more severe thing, going down towards 12 might be on the cards as well. A very strong market though, and something we brought to people's attention way down here. Sugar. We got positive at 1230. You'll see why in a minute. Okay. This is March 21. It's up over $1 today. So as you can see, there's a reason to be positive on this stuff. Once you got above 16, we got very positive. You see, it's holding the moving average, but we got bullish here at 1230. Right here, we got bullish. And as you can see, it's been nothing but a good deal ever since. And now it's above 16. And so Lord knows where it's going. Today was up big. Something we brought to attention months ago. And the last one is the price of coffee. And in the price of coffee, we are looking at up nicely. Again, it's been holding the 110, 111. See, and once it gets above 140, it could really fly. So as you can see, it's looking good. It's held the 120 area, and it also held the 115. So this area here between 115 and 120 is your support. And if it gets above 140, you can see it's an open field up there. So we'll have to see what happens there. Again, I got to sign off right now. This is optionprofessor.com, OPTIONPROFESSOR. For people who subscribe to our newsletter, they get particulars, they get specifics on our opinions and our observations, meaning much more specifics on stocks, bonds, interest rates, international, and updates on what we're doing in there as far as what we are focused on. We have a focus list that you get. So simply go to optionprofessor.com. And when you go there, put your email in. That gets you the free market update each week. And then email us at optionprofessor@gmail.com. to learn how you can subscribe at a very, very reasonable rate and get a weekly market update on the specifics on our opinions and our observations on all those markets we just mentioned, plus others. Okay. Thanks for being here today, you guys. Right now, I'm going to turn it back over to David. Again, optionprofessor.com to get the free newsletter, and optionprofessor@gmail.com to learn how you can subscribe. Thanks a lot for being here, guys. We'll see you soon. And David, back to you.
All right, thanks, Jim. Just a quick reminder to everyone, we have a, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory. You can also go to TimingResearch.com to get access to any of the past shows and reports, including this one, as soon as I can get it posted. And be sure to join us tomorrow. That'll be February 23rd, 4 p.m. Eastern Time, for the next episode of Analyze Your Trade. Michael Filiguera will be back for that one. And I just want to thank my guests again for today, the Option Professor of optionprofessor.com. Thanks, everyone.